The government literally hands you money when you put your dollars into the things they want built. I am going to show you exactly which investments the IRS pays you to make, how much they pay, why 90% of Americans never touch a single one of them, and how the wealthy have quietly been using these strategies for the last 100 years to build the kind of generational wealth that most people believe is impossible without being born into it. By the end of this video, you are going to understand the tax code not as a tool of oppression, but as a menu. A menu that Congress wrote specifically to reward certain behaviors, and if you just pick the items from that menu, the IRS will pay you to live the life the government wants you to live. Let me start with the single most important concept in the entire tax code, because if you understand this one thing, everything else becomes obvious. The tax code is not designed to be fair. It is designed to incentivize behavior. Every single line item in the tax code was written by Congress to steer money towards something. Housing, energy, business investment, retirement, education, charity. If you do what the tax code wants you to do, the tax code will subsidize you. If you ignore the tax code and just work a W-2 job and collect a paycheck, you pay the highest effective tax rate in the country. The average W-2 employee pays something between 25 and 37% of their income in federal taxes, state taxes, payroll taxes, and hidden fees. The average wealthy American pays closer to 15%, not because they have better accountants, but because they understand the code is a menu and they ordered off the right part of the menu. Now let me walk you through the investments the IRS actively pays you to make. The first one is so simple, it makes people angry when they finally understand it. Start a business. The moment you have a legitimate business, every economic relationship
Did you check your camera film the other day for the car?
My phone.
in your life changes. Every laptop you buy, every phone you use for work, every trip you take for a client, every meal you eat while meeting a prospect, every mile you drive between appointments, every subscription you use to run your operation, every dollar you spend educating yourself about your industry, all of it becomes deductible. And I am not talking about some small percentage. Under Section 179 of the tax code, you can write off up to $1 million of business equipment in the same year you buy it. A regular employee making $100,000 pays taxes on $100,000. A business owner making the same $100,000 can legally deduct tens of thousands of dollars in expenses before the IRS ever sees a penny. That is not a trick. That is the tax code working exactly as it was written. Congress wants more small businesses in America. They wrote the rules so that the more you invest back into your business, the less you pay in taxes. And it compounds over time. A business owner who invests aggressively in their operation can legally run at a paper loss for years while actually building real equity and real cash flow underneath. That is the game. The second investment the IRS pays you to make is real estate. When you buy a rental property, the IRS lets you deduct something called depreciation. Here's how it works. The tax code assumes that the physical structure of a building slowly wears out and loses value over time. For residential property, the lifespan is 27 and a half years. For commercial property, it is 39 years. So the IRS lets you take the value of the building, divide it by that number, and write it off against your income every single year. A $500,000 rental property with a $400,000 building value gives you roughly $14,500 in depreciation deductions every year for nearly 3 decades. That is $14,500 of income that the IRS pretends you did not earn, even though you did. But here is the part that will blow your mind. The property is not actually losing value in most cases. In fact, it is usually going up. So you are collecting rent, you are building equity, you are watching the property appreciate, and the IRS is still cutting your taxable income by tens of thousands of dollars a year based on a fictional depreciation that is not really happening. This is called a phantom loss. It is a loss on paper that is actually a gain in reality. It is one of the most beautiful accounting arrangements in the entire tax code. Now combine that with something called a cost segregation study. This is where a professional engineer looks at your property and identifies every component that has a shorter useful life than the building itself. Things like carpeting, appliances, light fixtures, landscaping, and parking lot surfaces, those components can be depreciated over 5, 7, or 15 years instead of 27, which means you can front load huge amounts of depreciation into the early years of ownership. A smart investor with $1 million rental can legally claim $150,000 to $250,000 of depreciation in the first year alone. That is a massive deduction against active income if you qualify as a real estate professional. And then we get to the 131 exchange. Section 131 of the tax code
It had a hole in it.
I don't know, I ate that stuff you gave me.
Huh?
You have the other one stacked on?
What are you talking about? I only got one pack. I handed them to you to put away. Like to put in the cabinet.
But you kept like half the pack and
I kept two. Because I was about to eat them and I ended up getting busy doing something.
Oh. And you gave me... And I put
The rest of them.
I put all the rest in the fridge.
No.
Yeah. But no, I ate them since then.
Mm. Huh? Yeah, I know. You wanna make me a couple of waffles? Will you just stick them in the oven for me then? No, just like medium or light. They're in the refrigerator. 3.
Says that if you sell one investment property and roll all the proceeds into another investment property within a specific window of time, you do not have to pay a single dollar of capital gains tax on the sale. You can do this infinite times. You can buy a small rental, sell it, roll the profit into a bigger rental, sell that one, roll the profit into an even bigger one, and keep going forever. You never pay tax. And when you die, your heirs inherit the property at what is called a stepped-up basis, which means all those decades of of gains are completely wiped out for tax purposes. The government literally lets the wealthy build and transfer real estate empires without ever paying capital gains tax on any of it. This is not illegal, it is not a secret, it is written directly into the code. Most people just never read the code. Now let me move to the third investment, because this one almost nobody talks about, and when I explain it, you are going to understand why the wealthy are so excited about it. Energy. The federal government wants American energy production. They want it so badly that they created tax incentives so aggressive they almost sound fake when you first hear about them. If you invest in oil and gas through what is called a working interest, you can deduct between 65 and 80% of your investment in the very first year through something called intangible drilling costs. Let me put that in real numbers. If you put $100,000 into the right energy project, you can legally write off up to $80,000 against your active income immediately. Not spread over years, not phased in, immediately in the first tax year. This is one of the only investments in the entire tax code that lets you deduct against W-2 income. It is specifically carved out for this exact purpose. Because Congress wants private capital to fund American energy. Renewables. Investment tax credit gives you 30% installation costs back. I want to be very clear about what it is. A credit and a deduction are two completely different things. A deduction reduces your taxable income, your tax bill dollar for dollar. If you owe the IRS $20,000 tax credit, your bill drops. It's direct money off the top. So if you install $100,000 solar, you get $30,000 back. Not a refund of your expenses, but a reduction of what you owe taxes. And you still own the solar system, that either saves you money or gets sold. That is the government paying you. There are also tax credits for thermal systems, battery storage, and even for buying certain electric vehicles. The Inflation Reduction Act, despite its misleading name, was actually one of the largest packages of energy investment tax credits in American history. It just was not marketed to regular people. It was designed for companies and wealthy investors who would know how to use it, and that is the theme of this entire video. The tax code rewards people who know how to use it, and it ignores people who do not even know it exists. The fourth investment category is retirement accounts. And I know everyone has heard of retirement accounts, but almost nobody uses them correctly. A regular 401k lets you defer about $23,000 a year. In 2026, that is the standard employee contribution. But here's where it gets interesting. If you own a business, even a small side business, you can open a solo 401k and contribute up to $69,000 in a single year. That is 3 times the limit of a regular employee account. You are contributing both as the employee and as the employer at the same time. And every single dollar of that contribution comes directly off your immediately reduce their taxable income to $131,000. At a 32% tax bracket, that is over $22,000 in tax savings in a single year, every year, for the rest of your career. And then there is the crown jewel of the entire retirement system, the health savings account. The HSA is the only account in the entire United States tax code that gives you a triple tax advantage. Money goes in tax-free, money grows tax-free, money comes out tax-free when you qualify medical expenses. There is literally no other account in the entire code that gives you all three of those benefits at the same time. Traditional 401k gives you tax-free going in and tax-free growth, but you pay taxes coming out. A Roth IRA gives you tax-free growth and tax-free coming out, but you pay taxes going in. An HSA is the only one that gives you all three. And here is the twist that almost no one uses. You do not have to withdraw the money for medical expenses at the time you incur them. You can pay medical expenses out of pocket, keep the receipts, let your HSA grow for decades, and then reimburse yourself later at any point in the future. Which means the HSA can secretly function as an additional retirement account with the best tax treatment of any account in existence. Now, I want to go beyond the four main categories because the tax code is full of smaller, lesser-known strategies that can stack on top of each other and compound your savings. Let me walk you through a few of the ones, the wealthy views that almost no one talks about. Opportunity fund. This was created in 2017 and it is